Hello, my name is Mark Mayfield, and this is another PFA monthly update. Now that we are post-election, the financial markets have started to shift their focus towards the government policies for the Trump administration, interest rates, what's going to happen with those going forward, and then the overall health of the U.S. economy. Stocks have performed favorably year to date, and so far post-election. So in this video, we're going to take a look at current stock market valuations and going to show you how today's valuations could potentially impact future returns. In this chart, we will take a look at the stock market valuations, in particular the S&P 500 index. The PE ratio signaled on the left side of the screen is simply a measure of price relative to earnings. So a high PE ratio would signal that potential holding is becoming overvalued. The S&P 500 index PE ratio is nearing its post-pandemic highs of 2020, and this can be credited to kind of some of the strong rallies we've seen from 2022 and then so far year to date, and that rally's mostly been built on inflation coming under control. The Fed's now starting to cut rates, and so now we're starting to see investments are a little bit more expensive today compared to their historical averages. So in the last slide, we looked at the valuation of the S&P 500, and now we're going to take a look at how valuations can impact forward returns. So as I stated earlier, there's a lot of enthusiasm in the marketplace right now. A lot of it's being credited towards, the recent rate cuts we've seen, and then also looking forward at some of the potential policy changes being brought forth by the Trump administration. Some of those are, lowering the individual and corporate tax rates, lessening regulation, and many more. We've seen similar optimism following the 2016 election when we kind of started to anticipate pro-growth economic policies. In this chart here, really what we're just looking at is, oftentimes elevated evaluations has corresponded to lower future returns. So we've talked about kind of the S&P 500 valuation and kind of what forward earnings potentially could look like, given that it's maybe a little bit overvalued. But just because prices are high does not mean you should avoid investing. Instead, you want to consider maybe spreading out your investments across various different asset types. So we've got the asset class performance map here that kind of shows you how different asset types have performed, over the course from 2007 through 2024. And really, at the end of the day, this just comes back to diversification. So one example, in this would be international stocks have a much more attractive valuation when compared to U.S. companies. Bonds, have not performed well here as of late with all the changes in the interest rate environment, but they do provide some additional, income and diversification benefits. So on the surface, long-term fundamentals suggest that the overall trend of the economy is moving in the right direction. Corporate earnings are showing steady growth. Federal Reserve has started to cut rates, which could spur some additional growth, and unemployment remains at low levels. So really, we want you to remain diversified in your portfolio and stick with your overall investment plan. If you don't have a plan, get one in place so you know why you're investing. But that's all we have for this month's video. Thank you for watching, and we will see you next month.